Hello and welcome. In today's volatile market, the focus on quality stocks at reasonable prices is more relevant than ever. But what does quality truly mean for investors? To explore this, we're joined by Ihab Dalwai. He's Senior Fund Manager at ICICI Prudential Mutual Fund, and he'll break down the strategy behind their new quality fund, its stock selection process, and why now might be the right time for quality to shine. Welcome, Ihab.
Yeah, thank you for having me.
So let's start with the basics. What exactly is a quality fund?
So see, I think one of the simplest way of defining quality is that companies or sectors or segments of the market which can generate high ROE, because ultimately return on equity is a good outcome if a company is a quality company, or return on invested capital. So if a company can do that, that can be a good definition of quality. So we've also tried to keep it simple in terms of the true definition of quality. But generally, what we've observed is that these companies tend to have low debt to equity. At times, they have net cash, and what we've observed is that when you couple a company with which has a high ROE with a good management, which is able to do good capital allocation decisions, uh, then what happens is that these ROEs are redeployed into high ROE avenues, as a result of which the compounding, the earnings compounding, which the company can generate over a medium to long term is phenomenal. And as a result of which the stock price returns are also good, because ultimately stock price would be a reflection of how your earnings can compound. But that is the outcome. But generally, what we've seen is that how does a company generate the high ROE? For that, they tend to have certain competitive advantages, or also known as moats, right? So then, what our job as active fund manager would be is to identify what is the moat of these companies, how durable, how sustainable these moats are, and in case keep checking if this moat is getting challenged or impaired. Because generally what we've seen is that high ROEs attract competition, because a lot of companies would also want to earn this high ROEs. So does the company have strong defendable moats to ensure that competition doesn't come in and the company is able to generate these high ROEs? So that is something which we would be doing as active fund managers. But from an investor perspective, generally, companies who's able to generate high ROE sustainably is something which can qualify as which would qualify as quality.
So, how does it differ from a typical equity fund in terms of stock selection and investment mindset?
No, that is correct, because generally, I think these would be a good starting point for an normal equity fund manager to also look at. Like, it has to be a well-run company, should generate high ROE. But I think the other fund managers, like other equity fund managers, would have flexibility to maneuver around. Like, Uh, ultimately, there has to be a balance between ROE, growth, and valuation, which you end up paying, right, at the time of stock picking. So here, what we are saying is that the quality fund would overweigh significantly in terms of the ROE aspect. It is okay if the company is slightly growing slower, and it is okay to some extent that it may trade slightly more expensive than the broader market. So growth and valuation is something which we will, as active fund managers, try to figure out how much to compensate in terms of at the time of buying. But what we're saying is non-negotiable is the ROE or the quality aspect of investing. So for another flexi cap fund manager, he may be slightly more growth oriented, maybe slightly more value oriented, or maybe a fund manager who would toggle between the three depending upon where he thinks he's in the market cycle or the earning cycle. But here, what we are saying is that for us, throughout the life journey of the entire product, we will keep focusing on ROE and quality.
Can you walk us through the key financials and non financial traits that you look for in such companies?
So financials, like I mentioned earlier, ROE is a good financial metric to identify. And there are different ways of, like, ROE is one simple form. You can do ROIC, because at times companies have cash on the balance sheet, which can depress the true operating return metric of the company. So ROIC is a good substitute to overcome that issue as well. But other financial metric, like I mentioned, tend to have low debt to equity. At times they have net cash. And when you do the industry analysis, right, for the stock which it represents, these companies tend to have higher margins than their peers. If if they are a leader or if they have the moat. So generally, better margins than the industries also can be one feature of a quality company. And other parameter is like the earning profile is quite stable, and so the volatility in the earnings also has to be slightly lower than what the broader market would be. So that these are key financial parameters. Softer aspects is, like I mentioned, good capital allocation. I think the capital discipline, which can be measured financially also, is that they need to be quite disciplined in terms of their capital allocation. They need like for the other software aspect is they need to be fair and transparent to minority shareholders. And I think one good way of doing that is that obviously they keep some capital for growth, like growth capital is kept aside, but the balance is paid out to shareholders. So I think a good dividend payout is also can be a good strategy, but that is after keeping aside the growth capital. We're not saying that you pay out the entire earnings or ROEs to the shareholders because we want these companies to grow. We want them to invest for growth as well.
Right.
But I think these are the aspects which one can look at, and I think capital discipline is important because if a company does some misallocation, because generally when things are good, management may want to do some inorganic acquisitions here and there, which is I'm saying if it fits the entire scheme of things, it's okay. But if it doesn't, I think that can be a bad indicator that the company is not focused on its core and wants to diversify beyond its core. So these are certain aspects which one can keep looking into to figure out whether the company is a true quality or not.
Right. Now, the fund follows both top-down and bottom-up strategies. So, in practice, how do you strike that balance? When does one approach take precedence over the other?
Yeah, so see, the conventional thought is that quality, generally the sectors which come to mind are maybe FMCG or IT as a sector, which has high representation in the benchmark itself. But we being active quality fund managers, we thought we should diversify it across sectors because our understanding is that you can find quality across sectors, like across most of the sectors. So I think that is what we are trying to do. Like we're going to make it across sectors, but the sector selection or sector allocation is going to be based on the sectors which we like. So it just because the sector fits into quality, it may not have a large representation in the actual fund. It'll have representations like sectors which we like will have good representation in the fund. So we believe that on an actively managing the sector allocation over a medium to long term, we can generate alpha through sector rotations as well within the quality basket. So I think that would be a good source of alpha. And from a bottom-up perspective, obviously, like I mentioned, though our view today is to be more towards large cap, but the fund would have some representation of mid and small cap as well. And those predominantly those small cap picks would be a bottom up ideas which we like. And we believe that you can build a good quality portfolio in a mid and small cap also. But today our view is to be in mega caps and large cap. So in case mid and small cap as a segment underperform large caps, we can actively build a decent sized position within the quality framework in mid and small cap space. So that's how I think broadly we feel it'll be a alpha generation strategy will be a combination of three, like basically sector rotation, capitalization rotation also over a medium to long term, and obviously our bottom up stock pickings, which will help us generate the alpha.
Now, high quality businesses, they often trade at premium valuations. So, how do you ensure that you're not overpaying, and especially in today's market?
So yeah, correct. I think one reason why we like this strategy now is that the segment has underperformed over like last 4 to 5 years. And generally, a segment which underperforms, I think the investor interest is muted in that space because if investor interest was high, it would have done better than the market. So less investor interest results in less crowding, and less crowding generally results in not too much valuation. But having said that, like you rightly said, these segment of the market trades at higher multiple to what the broader market would trade at. I think there are multiple ways of trying to figure out whether this is a justified multiple or no. Like obviously you can do a direct valuation in terms of absolute valuation in terms of doing a DCF or trying to figure out what is the value of these businesses, and then try to see what multiple is it trading at. And then you can try to figure out over a long-term cycle of the company, what is the relative valuation of its own of the company based on its own history. So these things which we keep doing to figure out whether we are overpaying or underpaying for the stock which we are buying. But like I mentioned, if today we're looking at it after a period of underperformance, so to some extent, valuation is reasonable. It is a justified valuation. I feel we're not overpaying for this segment of the market.
Okay, so like you mentioned, that quality as a style, it has lagged behind value and momentum in recent years. So what makes you confident that now is it is the right time for a quality comeback?
So I think from an earnings cycle or a business cycle perspective, right? Obviously, post-COVID, what we have seen is that we have been in a very strong recovery and growth phase of the market, especially in the earnings side. And earnings have been quite strong till FY24. Last year, what we have seen is that earnings have to some extent slowed down. I think this year we will end up having a single-digit earnings growth. Our view is that, at least my view is that we will be in a moderate earnings growth environment. We may not see the high earnings growth what we have seen post-COVID recovery till FY24. So generally, what we have seen is that in a moderate earnings growth environment, quality as a style does well because people want to be associated with more predictable, less cyclical cash flows and profits, which quality as a basket offers. What happens in a recovery and a growth phase of the market, right? Be it, I would say, low quality segment, like the basket outside quality, I would say is that these companies tend to have high leverage, and the leverage comes from two aspects. One is financial leverage and operating leverage. Because they have debt on their balance sheet, and as a result of which interest cost on the P&L, the delta of growth is quite high at the bottom line. Like if even if EBITDA grows at 10-15%, bottom line grows higher because of the debt which is there on the balance sheet. Second, they have operating leverage. Like I mentioned, quality segment has better margins than what the non-quality segment would have. So any growth and any margin expansion which happens during a high growth or a recovery phase, the delta is quite significant on the non-quality basket because like if margin is going up from 10 to 12%, that's a 20% growth in terms of EBITDA. Whereas for an quality as a quality basket, which generally tends to have higher margins, so 20% margin going to 22, that's just a 10% delta. So the delta is high in that segment. So we like this is true that in a high growth or a recovery phase of earnings or of the economy, not so quality names tend to do well because the earning growth profile is quite strong. But my view is that we are not in that segment of the broader earnings growth profile of the market. We are in a moderate earnings growth environment. So in that environment, quality does well. And like I'm not saying that quality will do well as soon as we launch the product. I think it has been doing well for some time now in terms of couple of months or a quarter or so because we've entered into that moderate growth or a slow growth environment.
But yeah, at a time like this, with macro uncertainties from tariffs to global tensions, they are weighing on sentiment. So, how does a quality centric portfolio help investors ride out such risks?
I think one of the key advantage of quality segment is that it reduces the risk profile because, like I mentioned, the earnings are expected to be less volatile. Because the earnings are less volatile, the stock price return journey is also less volatile. So on the risk parameter, quality stands out. And the risk adjusted return because of the lower risk, quality again stands out versus other styles of investing and broader market. So clearly, in an uncertain environment, quality should be preferred as a style of investing because of the lower risk which the product offers.
Okay, and one last question. Who is this fund best suited for? Should investors look at it as a core holding or is it more of a complementary piece in their portfolio?
See, generally, quality investing, I think it's a long-term or an all-weather kind of investing because if you look at the long-term history also, quality as a style has done better than the broader market over a long term. And what we are trying to present is that we, being an active fund manager of this style, I think our goal would be to generate alpha over that passive quality strategy. So I think the long-term journey has been quite good for Quality as an investor. And on top of that, you are timing it better because you're looking to enter this segment after a period of underperformance. Uh, and like I mentioned earlier in the start as well, like if it's run by good management, you need not worry because the management would do good capital allocation decisions and would try to compound the earnings of the company which they operate. So I think the long-term investor journey should be good, is what I feel. So it is a strategy which is for long-term, is what I feel.
All right, then. Well, that was an overview of ICICI Prudential's new quality fund, its structure, strategy, and where it fits in today's market. Thank you, Ihab.
Thank you so much. Thank you for having me.
Thanks. We hope this helps you understand the offering better so you can decide if it aligns with your investment goals. For more such conversations, stay tuned to Value Research Online and our YouTube channel.